There's, literally thousands of small and regional banks. You're going to have a real problem with earnings coming up because the, NIM, which is net interest margin, is really getting squeezed as their cost of funding is going up, and their loan book is yesteryear's levels of 4% rate on their fixed rates. And so you're going to see NIM really getting squeezed, which means they're going to have to probably look to cut the dividend. And the equities haven't really focused on that yet. I understand that KB is down 35%, the index of equities from the highs in February, but you're going to start to see an earnings problem coming next. So there's a liquidity problem and a earnings problem here that afflicts us.
So when Jamie Dimon says, as I write this letter, the current crisis is not over yet, you're nodding your head in agreement?
It's not even close to being over. It's just starting because you've seen $1 trillion of deposits leave the small banks and the regional bank system, and it's gone into the money market funds. So that's number one. And number two is you also have $1 trillion of debt coming due in the commercial real estate arena between now and the end of next year, as well as the CNI loans, which are starting to go sideways. So the banks also, in addition to having a liquidity problem and a capital raising problem right now, they're also going to have a problem with loan performance as the year progresses and we move closer to that recession that you alluded to.
You're looking for defaults.
Well, there's a few things here. First of all, in terms of the opportunity with the banks, we've been able to buy certain banks, regional banks. Now, just before coming here, I looked at about a dozen on a report that we're focused on, where in the last week, where the bond prices have fallen to 50, 60 cents on the dollar of these banks, so we're earning a 11, 12% current yield. Meanwhile, the book value is in excess of the equity capitalization. So we're doing our screens and we're looking for opportunity to buy into a falling market and buy some of the debt itself. We're buying assets out of banks as well. And we have a calling effort into banks to buy more of their assets because they have to shrink their balance sheet, that's for sure. And I think the final point of that whole arrangement is the banks are unable to really lend. Middle market lenders and private credit lenders, the shadow banking system is going to step up in a very big way to fill this void. Really important for corporate America and for real estate, which is moving towards a train wreck right now.
I mean, the other, I want to, somebody I'm sure, in that side of the business, Mark Lazary, who, when he is here, I talk to about the same issue, this direct lending and the idea of the yield that you can get. What yield are you getting right now on the money that you're lending out? 12 to 14%. Double digits.
Yes.
And you anticipate that continuing?
Absolutely. The base rate has moved up from 0 to 5%, the base rate being the SOFR rate, and spreads are then, spread off of that 5%. So it's the best lending environment that we've seen in a generation, which is why it's a particularly interesting time for lenders like Marathon and Mark Lazary's firm, Avenue, to be in the marketplace to lend to companies, because the banking system won't be there to make those loans like they had in the past, and it's super important that we provide this capital solution.
You made a quick buck, or 30 million of them in Credit Suisse debt, correct? How does that factor into how you think of the European bank troubles versus the troubles you perceive to be here, arguably at a smaller level because it's more at the regional level, whereas in Europe it's the big national banks?
Right. Well, in Europe, I think Europe's in a pretty good place. There are a couple banks that we're focused on, and I'd say that there's more to come there. But what Sergio and Coleman will be doing at UBS, we think is to absorb Credit Suisse and to run that bank brilliantly. And so we think the ECB will stand there to be lender when there's any kind of cracks. But here in the United States, the cracks are here in a very meaningful way in the regional banking system, where there are literally about 300 banks that we think need to raise capital, aren't potentially going to be able to raise that capital, and are going to have to be selling down assets. And the whole time, we think the deposit outflow will continue, and it will come in waves. And so I think that the Fed will stand up and provide all the liquidity they need to provide, and they have a huge toolbox that they learned from '08 that they can deploy. So I think the liquidity will actually be okay. It'll be a slow bleed, and it'll be the banks shrinking. And so that's not very good for the banking system in general. Really what it means is weaker equity prices for regional banks.